Hello and welcome back to the Naked Expat channel. Today I'd like to talk about the fundamentals of investing, and it doesn't really matter whether you're investing onshore or offshore, whether you're an expat already or if you're potentially becoming an expat. The same applies, and it doesn't matter whether you're European, Australian, British, American. The same sorts of things apply, and the same pitfalls apply, certainly when you become an expat, because the world of offshore investing is like the Wild West. And a little bit of knowledge is dangerous. So even if you think you know what you're doing, it's very different when you're offshore. I hope some of these points that I want to raise today resonate with you if you're an experienced investor. And you never know, you might actually learn something new, and be wary of it. If I can save you in annual management charges and costs and fees and being ripped off by the vast majority of expensive offshore financial advisors, then fantastic. Worst case scenario, but good for you, is I could save you the shirt off your back. So without further ado, let's just get on with it and discuss these briefly, if I may. Firstly, I've got a little list here as an aide de memoire. If we look at unit trust and investment trust, which you may be familiar with, essentially you have what's known as a bid-offer spread. So you have the cost of buying it and then what you're selling it. And the difference is what the broker makes. So if we look at a very basic example and think of 100 cents in a dollar or 100 pence in a pound, you buy at that rate, that's the offer price. You're buying it 100, but it's immediately worth 95, okay? That's the bid price. Now, the difference is 5%. Now, the difference there is known as the spread, the 5% spread. So the bid offer spread, 5%. You're buying it 100 and it's immediately worth 95. Same applies to currency. We all know that the difference in price of currency is between what you buy at a higher price and what you sell at, which is a slightly lower price. And the differential is the profit that's made by the broker. So that's bid offer spread. That's an immediate charge. And it applies to most things. If you're buying a unit trust, investment trust, anything, you have the cost of buying in, and then when you sell, what's the selling price? If you have a unit trust there at 100, that's the price that you pay for this unit trust, 100. But when you sell it, you're selling it at 95. Now, for diversification, you might hold within a portfolio more than one unit trust. Some broker might say to you, oh yes, but rather than just putting all your money in one unit trust, let's have a few unit trusts. And even better still, Mr. Client, what we'll do is we'll wrap all of that around in a big unit trust, in a giant unit trust, which is called a fund of funds. Now, a fund of funds is one big fund which holds other individual funds in it. And the reason why that's sold to you is diversification. Oh, but all of your money, say 50,000 US dollars, is spread between all of these companies' unit trusts. And one of the unit trusts could be with Fidelity in North America. One unit trust could be Fidelity Special Situations in Japan. One unit trust could be focused on technology. One unit trust could be focused on green energy, renewable energy. It's all very, very different and all spread out, which is, you think, oh, that's good. That's a great idea. But this is all subject to double charging because, of course, you have all of these unit trusts have their own bid offer spreads. So you're buying in and you're taking a 5% whack on each single one of those when you're going in. And an element of double charging because, of course, for running all of this, they also take a charge as well. So you've got a bid offer spread on the whole amount. So you've got 5% on the whole amount, and then or the underlyings, you've got bid offer spreads on those. Now, the person or the company running the whole fund of funds might say, yeah, but we can buy these at wholesale rates. It costs slightly less. Yes, it does, but it doesn't cost them nothing. So there's always an element of double charging in fund of funds. Now, why is that important to you? Because believe it or not, whether you know it or not, the vast majority of offshore investments encompass or include some type of fund-of-funds arrangement. Annual management charges. Now these are important because unit trusts, investment trusts and everything else, whatever product you invest in, it's got an annual management charge, an AMC, okay? And annual management charges typically range from between 1% and 1.5% per annum, because there's an annual management charge. Now that annual management charge applies to unit trusts, investment trusts, offshore investment bonds, onshore investment bonds. It applies to a lot of things, and that's coming out of your money. Now included within this may or may not be a financial advisor commission. Generally, in places like the UK, for example, the product provider's annual management charge is 1%, but they'll levy 1.5% because 0.5% of that is commission, which goes to your financial advisor every year based on the value of your investment. So if you're lucky enough that your investment grows in value, they're getting 0.5% of an increasing amount each year. Now that may not be a problem because you think, okay, if the financial advisor's making me money, they make more money, I make more money, everybody's happy. But the problem is when you're losing money, they still get paid their 0.5% commission, irrespective of how much your investment is actually worth. Now, why is this important? Well, the reason it's important is because, as with a lot of investments, as a domestic investor, the odds are stacked against you, always. They're always in favour of the financial advisor and the broker. When you invest offshore, offshore investment is like the wild, wild west. And trust me, there's a lot of other hidden charges, double and triple charges, which I want to explain to you today because you may not be aware of them. The vast majority of products that are sold offshore to expats are what's known as portfolio bonds or offshore bonds. And they are a potential minefield, and I'm going to show you why. A portfolio bond is essentially an empty wrapper. And within that portfolio bond, you can hold whatever investments you want. High risk investments, low risk investments, stocks and shares, unit trust, investment and trusts, and every other complicated investment under the sun. A lot of the investments that you can hold in offshore portfolio bonds wouldn't even be allowed in more highly regulated jurisdictions like the UK and Europe. But offshore, you can pretty much put in there what the hell you want. This is where it becomes very, very dangerous because a lot of the investments that are advised by offshore financial advisors to go into these portfolio bonds are extremely unique, and that's putting it politely. As I've already said, investing offshore is like the wild, wild west, and the vast majority of offshore financial advisors are a bunch of cowboys. Doesn't matter whether they're based in Thailand, Philippines, Dubai. They got one thing on their mind, and that's to make as much money out of you as possible in the form of commission. If they say otherwise, they're full of shit, because ultimately they're like double glazing salesmen. They're in it for themselves, you are secondary. If they say anything else, don't believe them. Unless they're working on a fee basis and they're charging you per hour, and that's extremely rare. Now, these portfolio bonds are not run by offshore companies for nothing. These offshore companies are not charities. A portfolio bond will typically have an AMC, an annual management charge, of about 1.5%, possibly even more. Let's be fair and take a conservative average of 1.5% per annum. That's the charge for the wrapper. That's before you've done anything. Now, within that portfolio bond, you can hold whatever you want. So let's say your financial advisor says, oh, you'll balance risk, let's have a few unit trusts and investment trusts. Let's have some stocks and shares. Let's have some low risk guaranteed notes. The guarantee is only as good as the company that issues the guarantee. And most of the time, those companies you've never heard of. So good luck with that one. But let's say you've got some notes, they're a bit different, You've got various different investments in here. If you're familiar with the unit trust and investment trust, because they look similar to the ones that you've had in the UK, then great, that's fantastic. Chances are a lot of these investments are very, very obscure. And there's a reason for that. These investments that are held within the portfolio bond, this is a trick that a lot of offshore financial advisors use because they do not need to have full disclosure on all of the commissions that they are charging or getting from the product providers. They may disclose to you, for investing in this portfolio bond, if you're lucky, they may admit to the fact that they're getting, say, 5% commission. So you know that if you're investing 100K, say $100,000 in this portfolio bond, it's immediately only worth 95,000 because that's the cost of going in. And you might accept that and say, well, you don't get anything for free, so well, fair enough. 100,000 goes into the portfolio bond and it's immediately worth 95,000. But that's the cost of buying. And on an annual basis, I get charged 1.5% per annum annual management charge. Because here's the real kicker. This is where they kick you in the nuts for the first time of many. All of these underlying investments, if they're quite obscure, a lot of these underlying investments have deals when they've got their representatives going around talking to other financial advisors offshore and say, hey, look, if you recommend our unit trusts, investment trusts or notes, whatever they might be, our annual management charge is 1.5%, but we'll give you a kickback of, say, 0.5% or 1% as a little sweetener. But, you know, nobody knows about that, but we'll give you a kickback for it. So not only is the financial advisor getting 5% commission on the way in, of this 1.5% per annum product charge, the company that runs this portfolio bond might be giving, out of that 1.5%, they might be giving 0.5% per annum to the advisor. Say your independent financial advisor is getting 0.5% per annum of that investment, okay? Based on the value of the investment. But also, these underlying funds, a lot of them, will indirectly, outside of the portfolio bond, will also give the financial advisor, say, 0.5% per annum, which you don't see because it's an offshore bond. They don't have to declare it. They don't have to declare it to the product provider, and they don't have to, and you don't have to declare it to anybody else because offshore investment is very under-regulated. So already they got 1% per annum in commission from you every single year. Now, is that quite bad? Yeah, but that's not it. We've not finished. Also, these portfolio bonds can have what's known as discretionary management fees. That's another fee that the financial advisor can levy. And he may or may not disclose it to you in the small print. And he might say, oh, I'm the big I am. So for managing all of this, Mr. Client, on top of the 0.5% commission he's getting on an annual basis, they levy between 1% and 2% per annum as a discretionary management fee. Because they say, oh, you know, I'm going to come and see you every year and we need to buy and sell these investments and mess around with it and probably lose you even more money. So there's a discretionary management fee on top of that, which they get paid. The product provider, the portfolio bond provider, whomever that may be, will charge it, but it's going to the financial advisor. And that is typically 1 to 2% per annum, but we'll be kind and we'll say that that's 1% per annum. Now, 0.5%, 1%. So that's 2% per annum that the financial advisor's getting. You're also paying 1% of the 1.5% as a product charge to the provider. So we've already got 2%, 1%, that's 3%. 3% per annum is your annual charges. On top of the 5% you've paid on the way in, I won't even get into the third one where they'll kick you in the nuts even more because some of these have exit penalties, which means you're double charged again because there's fees on the way in, but there's also fees on the way out. So you're damned if you do, damned if you don't, because if you fall out of bed with the financial advisor and you want to chop and change, they'll get another hit and they'll get another 3, 4, 5% as charges on exit. So be careful of that. And also the portfolio bond may have early surrender penalties as well, which means if you leave them in the first 5 years on a decreasing scale, they'll hit you in the nuts as well. It's not liquid. So you're getting 3% per annum in charges before you even make any money. You've got to make 3% to stand still. How much is inflation? ask yourself, approximately, the average basket of goods, inflation, is, let's be fair, in some places, certainly in Asia, it's rocketing above 6-7%. But let's just say annual inflation is always a marginal 3% per annum, okay? 3% inflation. So, in today's terms, you're getting hit in the nuts with 3% per annum annual management charges on portfolio bonds. On top of that, average conservative inflation is 3% per annum. That's 6% per annum. To stand still, this investment of yours needs to make 6% per annum. I know in my 20 years of investment experience that the average investor, net of charges, is happy with about 5% annual return. How the hell are you going to do that? You're basically going to be losing more and more and more and more money every year. And this is what really pisses me off with offshore financial advice. The vast majority of it is extremely poor and does not have the client's best interests at heart. And this is being conservative on some of the charges. Anyway, we'll move on. Right, thanks for bearing with me. I've wiped my board down so we can still continue to rock and roll. A lot of banks in Europe, especially in the UK, are closing down expats' bank accounts. The reason for that is if you are an expat, you say you're a British citizen and you're moved abroad, you are no longer ordinarily resident in the UK. Therefore, technically, you shouldn't have a bank account in the UK. And true expats have made a clean break from the UK. Now, I know a lot of you guys will maintain a UK address, maybe for NHS reasons, have your bank account registered with friend or family or what have you. Yeah, cool, I'm not dissuading you to do that. It's not the right thing to do, of course. However, whilst you can maintain a UK bank account, great. The chances are these guys are going to catch up with you. Barclays and Nationwide, I hear it all the time, every week from expats where they've lost the control of their bank accounts in the UK. They're being closed down and they need alternative arrangements. So rather than being reactive, being proactive and having an offshore bank account and offshore investments may well be the more prudent thing to do, because technology is getting better and better and better all the time. And I think it's only a matter of time before the vast majority of British expats, certainly, that are based abroad, are going to end up losing their banking facilities in the UK. So it is quite prudent to have other strategies. With this in mind, investing offshore, apart from all of the issues I've already highlighted with portfolio bonds, which is the most popular type of investment for a lot of these so-called independent financial advisors offshore, that are still commission-based, like the way the market was regulated in the 1980s and 1990s in the UK, where basically nothing had to be disclosed to anybody. It's still very similar to that in the offshore market. When you're based in places like in Asia, Thailand, Philippines, for example, a lot of the local banks do have products available to expats. And in the Philippines, for example, as an expat with a verified account, you can invest in various funds with GCash. You can invest in various funds with the majority of the banks in the Philippines that have facilities for expats. I'm not going to mention any one in particular because they're all as bad as one another. But essentially, most of these banks run what's known as feeder funds. And it's the same with GCash, for example, where you can invest money via GCash if you want to. And they're feeder funds. And you go, well, what the hell's a feeder fund? Well, a feeder fund is essentially a white labeled product. And the company like GCash or the bank is just the middleman. They're the fixer. They put A in contact with C and they're B in the middle. And they take some commission for the privilege of doing that. The way that feeder funds work, and this is important because they're all over the place in Asia, is that you have the client, you're the investor there, and you want to invest in this fund. Because it's local, maybe you want to invest in this fund for the benefit of your girlfriend or your fiance or your wife. And it's not for you, but you want it local in Thailand or the Philippines because, you know, it's a little sweetener for them, or even your children or grandchildren. I looked at this for my son. I'm a solo parent. I looked at investments within the Philippines before I sort of laughed and almost threw up and did something offshore instead. But If you're interested in doing something local, this is where you have to be very, very careful. Again, Asian markets are not as mature as markets in the West, certainly in the UK, Europe and America, for example, where they're light years ahead when it comes to charges and everything else. In Asia, again, it's still the Wild West, and investment products are generally very, very expensive. Now, you're the investor and you want to invest in this fund. Most banks and financial institutions in Asia don't really want to run their own funds. They subcontract to investment houses. So they just say, okay, well, we'll introduce you with all of our clients, all of our account holders into this fund, but what are you going to give us for it? So they're the middlemen. But they want to make out that it's their own funds because it gives them credibility. So this fund might be managed by XYZ company, who's a broker. But you're an investor with a bank, and the bank is called, say, TMC. Just pick that out of nowhere. So you're a client of TMC and you want to invest in this. You're not really going to want to invest in this fund because you're going to think, well, who the hell are XYZ? I've come to the bank. So you go into the bank, you go into TMC and say, I've got some money to invest. I want to start off a savings plan. I want a unit trust, investment trust, or some long-term type of fund for the benefit of my wife or for my children. My son's 2 or 3 years old and I want to invest for the next 15 or 16 years until he's 18. They'll say, oh, okay, sir. Well, we've got funds to invest in. You invest in there, and it's a TMC fund. But it's called TMC Feeder XYZ Fund. Oh, okay, well, it must be something to do with TMC. But it's just a feeder fund. And it goes to XYZ company to be invested. The annual management charges on the fund is, say, 1.5%. Because Asia is a lot more backward, it's not going to be like 0.2%, like a lot of funds in Europe and America now. It's going to be 1.5%. That's their annual management charge. But TMC Bank ain't going to do it for nothing for you because they're not a charity. Everything's cost money. They want, say, 0.5% out of it as well. So you pay an annual management charge of 2%. That's what you get charged. You get charged 2% a year. XYZ fund managers get 1.5% of that. TMC Bank get that. And on top of that, the bid-offer spread. Bid-offer spreads, as I said at the very beginning of this presentation, is normally around about 5%. And within that, 2% normally goes to XYZ, the product provider, and 3%, surprise, surprise, is normally commission. And that'll go to the bank. So you invest for every 100, you invest and it's immediately worth 95. Okay, you get the bid offer spread on top of that. So for every 100, it's worth 95 cents on the dollar. That's the initial hit on the way in. TMC get their commission. On an annual basis, you're being charged 2%. XYZ fund managers keep 1.5% of that, and they kick back 0.5% to the bank. Very expensive. Very expensive, is it? Well, I'll show you how expensive it is. Right, back to a clean whiteboard again. Why are these investments expensive? Well, because bid offer spread is old school. Yeah, 5% on the way in. And annual management charges every year of around about 1.5% per annum. Okay, so 5% cost on the way in, and per annum 1.5% annual management charge. Those days are gone in Europe and the States, well gone. Thanks to companies like Vanguard in the States, which then populated a lot of investments in the UK and Europe as well, you have what's known now as ETFs, or exchange traded funds. Now, ETFs are absolutely fantastic in most instances because of the very lean charging structure they have. In most instances, it costs you nothing to invest in an ETF, and it has an annual management charge of anywhere between 0.2 to say 0.75% per annum. 0.75% per annum would be expensive. The vast majority of exchange traded funds, ETFs, cost you nothing to invest, and the AMCs, the annual management charges, are 0.2, 0.3% per annum. Bugger all, but it's economies of scale because ETFs have billions and billions of dollars and sterling in the UK invested in them. Not only are they cheap, are they any good? Because you don't want to end up buying crap, like most products that come from China, excluding the iPhone, because that's very, very good. This brings me to an absolutely fundamental thing about investing. Most fund managers underperform the market. So remember when we were looking back at portfolio bonds and unit trusts and fund of funds, how all of these funds are taking a piece of the action and charging you for it? Well, that's because they've got glorified fund managers that sit in their ivory towers managing your money, and in most instances making a complete hash of it. I'll explain. Now, in its most basic terms, value over time. So let's take a 10-year period, and that's the market index. Doesn't matter what market it is. Could be the FTSE 100, could be S&P 500. Doesn't really matter. Dow Jones, whatever the index is. Let's assume a well-known prophecy is investing is more about time rather than timing. So risk drops the longer you hold that investment. If you only want to invest for a short period of time, probably not worth investing in equities because they're very, very volatile. But risk does diminish over time because you're investing over a longer period of time. Chances are you're going to make your money back, even if you had losses initially. It's not always the case, but it's a general given. Now, that's what the index is doing. Now, 98% of fund managers underperform an index. So let's take an index, for example, the Dow Jones. Let's take the Dow Jones index, and it does whatever it does over a 10-year period. So let's just say it starts off at $100, and let's say after 10 years, it's $400. Not pounds, sorry, beg your pardon. So it starts off at 100, and after 10 years, it's worth 400. Fund managers mess around with your money, and they won't get full exposure to the Dow Jones. Let's say it's a Dow Jones, but they think, oh, okay, well, I'm not going to invest in all of the companies in the Dow Jones. We're going to invest in the ones that we think are going to do the best over the next 10 years. So we're going to cherry pick. We're going to pick and choose. Of course, they haven't got a crystal ball. Most of these fund managers are full of bull anyway, and they don't really know what they're doing. And this is the reason why. And this is the majority. This isn't the exception. This is the majority of fund managers that, remember, you're paying 1.5% annual management charges or more for them to mess around with your money. It may be that they start off the same, same as the Dow Jones, and they do slightly better because some of their shares that they've bought are doing much better than the average. And then let's say they underperform, and then let's say they sort of overperform, and then they massively underperform because they bought or sold the wrong shares at the wrong time, and then they sort of creep up, and they do that. That's a lot of fund managers, and it can be whatever you want, but the general idea here, you get there, is 97% of fund managers don't beat the market. They underperform the market. 97%. So what the hell are you paying them annual management charges for? Why not just go into an investment which tracks the index? Well, that's what most ETFs do. The reason ETFs, exchange traded funds, have very low annual management charges is they haven't got some glorified fund manager driving around in a Porsche 911 with fancy suits and smoking cigars and drinking champagne. No, they haven't got that. They basically just track the market. It's computer programs and algorithms. And whatever the market's doing, whatever the exposure is to the Dow Jones, they copy it. So how well does it do? Well, there you go, Sherlock. It's the black line. That's ETFs. They mirror the market. And whatever the index does, that's how the ETF does, with a small margin of error. That small margin of error is called standard deviation. It's a slight part of deviation, because nothing is going to exactly mirror the market, but it's going to mirror it as near as makes no difference whatsoever. 99.9% mirroring with extremely marginal deviation. Time for me to wipe my board again. I hope you found this useful. Do need to bear in mind, as an expat, you're moving into the Wild West. If you are able to hold funds in the UK or in America or in Europe, then fantastic. But there may be a time in the future when you're long-term, not ordinarily resident in your country of domicile, where you do need to move your investments. It may be prudent, depending on your circumstances, to consider offshore investing now. But with a financial advisor, I know a couple, I've been in the industry for a very long time. If you contact me via the comments box below, I'll put you in contact with somebody who knows what they're doing and works on a very, very fair basis. The key takeaways from this as an expat is that you need to be aware of double charging, double or triple charging. What are all of these charges within the product? Because a lot of them, surprise, surprise, are undisclosed. Undisclosed commissions, undisclosed annual management charges, hidden charges that institutions could not get away with in the UK, Europe and America, but they're still able to get away with in places like Asia, and all of these financial advisors that are based in Asia, Dubai and everywhere else. They're just ripping you off left, right and center. As I said in the beginning, a little bit of knowledge is dangerous. You might think your financial advisor is wonderful. Ask them these questions. Really dig down, peel back the layers and see exactly what you're paying for, because I bet you are paying more in charges than you thought you were. And finally, as we touched on just a moment ago, underperformance. The vast majority of fund managers, over 97%, underperform the index. So why the hell are you not just in a basket of tracker funds? You've got to track America. It's the largest market, and there's a very, very famous saying that when America sneezes, everybody else catches a cold, and it is fundamentally true. If you exclude the North America outside of your investment portfolio, you're an idiot, unless you're extremely low risk, because America will dictate what happens in the rest of the global economy. So you need to make sure you've got North America exposure. If you are balanced risk, if you're no risk whatsoever, then you shouldn't be in equities. And do remember, as a rough guide, for every year of your life, you should have a 1% in fixed interest. That means if you're 65 years old, you should have 65% of your money in fixed interest and only about 35% exposed to the market in some way, be it in equities, stocks and shares, unit trusts, investment funds, whatever you're in. If you're 75 years of age, you should have 75% in fixed interest and nothing to do with the stock market. So you've only got 25% exposed to the stock market. If you're 80, the maximum you have is 20% exposed to the stock market. Now, I know that's extremely basic, but as a general rule of thumb, we're not at the London School of Economics now. As a general rule of thumb, it's a very, very good guide. Don't get too cocky. Fixed interest, property, things that are fundamentally outside of equities is a very, very good idea. Don't put all your eggs in one basket. At the end of the day, KISS rules. Keep it simple, stupid. Most offshore financial advisors will be advising you and they'll be pushing investment funds within these portfolio bonds that you've never heard of. Even if you've got some investment experience, you've probably not heard of some of these obscure investments. Stay away from unregulated, obscure investments. Nothing obscure, because most of these obscure funds are loaded up with either high entry or high exit charges and hidden kickback commissions to the advisor, so they get two bites of the cherry. So be aware of that. If you're not familiar with the investments, get them to justify them and ask them why, and ask them what the underlying charges are on the funds as well as the actual product wrapper itself. Some offshore investments are extremely good, like offshore investment platforms, and platforms that are run by companies like HSBC and some of the legitimate offshore providers in the Isle of Man, for example, are just an investment platform, and within that platform you can hold whatever you want, a bit like a portfolio bond. But unlike a portfolio bond, which is highly structured with high entry costs, these platforms only carry, say, a 1% annual management charge, and you can invest in whatever you want. Unit trusts and investment trusts, keep it familiar, keep it with what you're aware of, and stocks and shares and everything else. And you can buy and sell. They're very, very liquid. They don't have any high exit penalties, etc. And they're run by companies like HSBC International, a lot of the major international banks. They are based in Isle of Man, based in South Africa, based in Hong Kong, that are highly regulated and extremely competitively priced. They're worthy of consideration. It does come down to having the very best high quality advice as an expat. If you invest in the UK or in your home country of domicile, the US, Europe, Australia, that's probably your best bet in the short term. Those countries are highly regulated and the annual management charges and commissions or fees are very, very competitive. And of course, everything needs to be disclosed to you. When you become an expat, a lot of those rules go out of the window and there's a lot of hidden charges. And most offshore investments from providers in Asia are an absolute rip-off. So you have to be extremely careful. It is the wild, wild west out there. And the only people that benefit are the product providers and the financial advisors, the majority of which work on a commission basis, not on an hourly fee basis. Offshore financial advice in a lot of jurisdictions is decades behind the West. Not all jurisdictions, but certainly some of them. You're aware of this now, and if anything that I've said helps in any way for you to avoid the pitfalls of others and avoid you getting ripped off or losing the shirt off your back, then I'm really chuffed with myself, because that's my intention. If you don't know a good financial advisor that's based offshore and you'd like me to put you in contact with one, my details are in the description. Drop me an email and I'll introduce you to somebody that's highly regulated in your jurisdiction. Please like and subscribe. It does help my YouTube channel to get this out to as many people as absolutely possible. I don't want you guys getting ripped off. I'm fed up with all of the bullshit that I hear about offshore investing and onshore investing, when I know darn well that these guys, the vast majority of offshore financial advisors, are ripping you off. Thank you.